You move to Panama, you keep your European clients, you keep billing them in euros, you keep depositing that money into a local bank account. Your tax bill on all of it is zero. Not because you're hiding anything, not because of some offshore scheme, because Panama, like 28 other countries, only taxes income earned inside its borders. Everything you earn from clients, investments, or businesses outside the country is completely outside the tax net, legally, permanently, and by design. 29 countries have built their tax systems this way, and most people, including most accountants in high-tax countries, either don't know this or don't understand how it actually works in practice. And today I'm going to walk you through the 4 categories of territorial taxation, the specific countries in each one, the real differences between them, and which one actually makes sense depending on your situation. Because the framework matters. Not every territorial system works the same way. And getting this wrong is just as expensive as not knowing about it at all. And if you're new to this channel, I'm Teodora from the Passport Investor, a global advisory firm. We help entrepreneurs, investors, and remote business owners restructure their tax exposure legally through international residency and business structuring. The most common reaction when people first hear about territorial taxation is that it sounds too good to be true, and it's not. These are sovereign governments making a deliberate policy decision to only tax what happens within their economy. They attract capital and talent by leaving foreign income alone, but there are 4 distinct versions of this system, and the version you choose matters. And first, a quick baseline so this makes sense. Most developed countries use residency-based taxation. If you live in France, Germany, the UK, or in the Netherlands, you're taxed on your worldwide income, and it doesn't matter where you earned it. If you're a tax resident, everything is reported. The United States goes even further. Citizenship-based taxation means Americans owe tax regardless of where they live or earn. And for entrepreneurs and remote workers, this creates a problem. Your income is global, but your tax system assumes everything belongs to one country. Territorial taxation flips that. These countries say we only tax what happens here. What you earn abroad is not our concern. Now, there are 4 ways countries implement this. Category 1, pure territorial systems. These are the cleanest. Foreign income is completely exempt. No conditions, no remittance rules, no time limits. Panama is the clearest example. If your income comes from outside Panama, it's not taxed. Even if you bring it into a local bank or spend it there, capital gains on foreign assets are also zero. Then we have Paraguay, which offers a similar system. They have a 10% tax on local income, 0 on foreign income. Simple and efficient. And also Costa Rica, which also follows this model, with the key point being that income from foreign clients with no local activity is generally not taxed. Then in Asia, we have Hong Kong and Macau, which apply territorial taxation as well, but with stricter source rules. Where you physically perform the work matters more than where your clients are. In Asia, we have category 2, remittance-based systems. These countries tax foreign income only when you bring it into the country. If you keep it offshore, it remains untaxed locally. Singapore is a classic example. Foreign income is taxed only when remitted. With proper structuring, this creates significant flexibility. Then we have Malta, which is the key option in Europe. You pay tax on foreign income only if you bring it into Malta. Foreign capital gains are not taxed even when remitted. It's one of the most flexible systems inside the European Union. Then we have Mauritius, which applies a flat 15% tax, including on remitted income, but maintains 0 capital gains tax. And of course, Gibraltar, which caps total annual tax for high net worth individuals, creating a predictable ceiling regardless of income level. Of course, Category 3, territorial systems with carve-outs. These are where people make mistakes. On paper, foreign income is exempt, but in practice, certain rules can reclassify it as local. Georgia is a good example. If you physically work in Georgia, even for foreign clients, that income can be treated as local and taxed. This is where digital nomads often get caught. Location matters. Other countries like El Salvador and Namibia also fall into this category, but require careful planning and professional advice. Category 4, tax holiday systems. These give you a temporary period of zero tax on foreign income. Uruguay offers a 10 to 11-year tax holiday for new residents. During that time, foreign income is not taxed at all. After that, some types of income become taxable. Then we have the Dominican Republic, which offers a shorter exemption window for foreign investment income. These systems are useful as a transition strategy, giving you time to restructure before committing long term. So which one makes sense? If you want simplicity and clarity, you go for Panama or Paraguay. If you want to stay in Europe, then you go for Malta. If you want strong financial infrastructure, then you go for Asia, Singapore. And if you want a low-cost entry with citizenship potential, then Paraguay would be the best option. And if you want time to plan, Uruguay. The right answer depends on 3 things: where you want to live, what type of income you're protecting, and whether you want a second passport as part of the strategy. And if you are ready to make the next step and go fully international and optimize your earnings, feel free to book a strategy session with our team at Passport Investor. The link is below in the description, and we will help you take your life fully international.